Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. Pleased again to be joined by Kyle Ryan, joined by Kyle.
Either works.
Right. Okay. Kyle Ryan is joining me.
There we are. Yeah.
Also a certified financial planner, an equity owner in the company, my lead advisor with the company. Kyle, thanks for joining me.
Absolutely. Thanks for having me again.
So this is part two of a case study that we're doing for John and Mary. I'll kind of restate some of the base facts. John is a business owner. Mary works, a separate business.
Yep.
They're both 62 years old. The major issues here, they have about $1 million in IRA assets. They have about $3 million in non-qualified investments. They have about $1 million or $2 million or so in the bank earning virtually nothing. And then they got about $20 million worth of rental properties. So his net worth or their net worth is to the tune of around $25 million.
Yep. 2 children.
And 2 children. Thank you very much. One that is in the business, one that is not in the business. So, what we talked about in the first episode were basically really elaborated on the cash management. We elaborated on the, because this covers all 6 areas of financial planning.
Yeah, that's a good one.
Cash management, tax planning, risk management, which is insurance planning, investment planning, retirement planning, and estate planning. We knew we couldn't cover them all, so we touched upon a couple of these. It was the cash management. Clearly, we're going to take a lot of the money that we're sitting on that's earning virtually nothing and making virtually something. Okay.
Yeah.
And we're going to talk a little bit more about that because we're going to talk about why we decided to go with extremely low volatility, low risk, ultra short municipal tax-free bonds that are yielding about 3% versus money market that's earning 4%. From a tax perspective, to them, it's about identically even.
Yes.
Okay. So then we talked a little bit about the insurance planning. All their insurances are covered. The only thing that we talked about is that he really needs to march down to his property and casualty insurance agent and say, hey, look, we need to look at each of these properties to make sure that each property is adequately insured just because of the capital appreciation and the growth, as well as costs for replacement.
Yes.
Okay. And then also to take a look at his umbrella liability insurance to make sure that he's adequately insured there, because the last thing you need is a slip and fall or something like that to wipe out all of the properties. Now, the good thing is that all of those properties are in an LLC.
Yes.
Okay. So by definition, LLC means that if something happens, it limits their liability to whatever's in there. But come on, 20 of their $25 million are in that LLC.
Yes. Yeah.
We don't want to lose that $20 million.
No.
Okay. So it's good to protect yourself. And so we recommended he march down. So now let's talk about one of my favorite topics is always the tax planning.
Oh,
okay.
Good guest.
Actually, I'm going to step back because I really want to finish
Yeah.
with the tax planning and the estate planning. There's not a lot to talk about as it pertains to investment planning with his regular investments, other than we're just going to be making sure that the investments are consistent with his risk tolerance and that the investments are structured properly from a tax perspective. So hypothetically, if he wants a certain amount of stocks, certain amount of bonds, we want to make sure that the bonds are tax efficient.
Yes.
And oftentimes tax efficiency of bonds is you stuff them in your IRAs.
Yep.
Okay. So really not a lot to talk about there because, the 1 pound mouse in the room stands nowhere near the couple 800-pound gorillas.
Yes.
Okay. So we're leaving that alone. So, the tax planning piece let's go to retirement planning because the practicality of the matter is
he's got cash cows, between the business ownership that he has, between the rental property he has, income isn't per se a concern for him in terms of just being able to afford retirement because he plans on, well, for one, he never plans on retiring, so he says. So we'll see how that works out. If he ever retires from that, until then, he'll have the profit of the business, the salary he pays himself, and then, the $20 million worth of rental properties will provide a little bit of cash there.
Well, but he's also a 62-year-old Energizer bunny, okay? Because, you know me, I'm sending my emails out at 5:30 in the morning, getting responses from him.
Yep.
And When I get up at 5 o'clock in the morning and reviewing
See
emails,
what
I'm
from
seeing his
11 at
emails
night.
from 11 o'clock.
Yep.
Okay, so that's the Energizer Bunny. He ain't retiring anytime soon.
So,
And by the way, he is as young of a 62-year-old as I've ever met or seen. And quite frankly, he loves what he does.
and he gets to work with his son,
Exactly.
Why
Exactly.
not
So
show him the ropes as long as you can?
absolutely. So he has no urging, burning desire of
No.
retiring.
Just make sure the cash flow that comes through, once again, is tax efficient. Rental income's fine. We're going to talk a little bit about the salary coming up here, but he's from a cash flow perspective, he's well set to retire when and how.
Anytime he wants. He's got enough assets to retire and live comfortably for the rest of his life. So retirement planning doesn't really come into play. The only thing that you could argue falls under that bucket is the retirement plan that we're actually setting up at work. So let's talk about it.
Yeah.
So he has no retirement plan at work, but what we're saying is like, hey, you know what? Why don't we set up a 401k? Right? Why? Because Secure 2.0 that just came out a couple years ago provides the opportunity for business owners to establish a retirement plan at work for free.
Now, how could that be?
How could that be? Because what they do is they give you tax credits for 5 years. And then they also give you a credit for up to $1,000 of what you're contributing to each of your members of your plan. Up to $1,000. And if you have somebody who's making $30,000 and they're contributing 3% and I am matching 3%, that's $900. I get $1,000 credit.
And yes, 401ks have a cost, but when you get that tax credit offsetting almost all of your costs in the first few years, beautiful thing.
Right. So, and not only that, so by setting up the 401k, you could set up a 401k and the issue is going to be at first glance is it's going to minimize how much he can contribute because of the rank and file is not contributing enough. However, if he establishes the plan with what's called safe harbor creates the opportunity for the business owner to put in within guidelines whatever he wants. And then all he's got to do is just give the employees a certain amount, which there's two choices. He can either give everybody gets 3%, regardless of whether they contribute, or he'll match dollar for dollar for 3, 50 cents on the dollar for the next 2. So it's a total of 4%. Now, we're not talking about doing this plan until next year.
Correct.
So what this has given us the ability to do is to do an evaluation of which there's no real way of knowing yet, but he can kind of fish around and see whether it's more advantageous to go with plan A, that's 3% for everybody, or plan B, that it's a match.
It's more of a pay to play. You look at an employee census, see what everyone's making in the last couple of years. It's an evaluation. It's not the hardest thing to do.
Right. Exactly. So we got a little bit of time with that.
Exactly.
And so, we're talking about establishing that plan, which then gives him the opportunity to play the game, because it's interesting, first of all, instead of contributing a whopping $8,000 each because they have no retirement. Actually, no. His wife has a retirement.
Yeah, she has a
because she has a 401k, that means he can't contribute. But if he establishes the plan at work, he can contribute $23,500 because he's a living, breathing person. An extra $7,500 because he's over the age of 50. That's a catch up. And that new thing.
Yes, the enhanced catch up,
which gives you an extra 50% of the $7,500, which is $3,750.
Yes.
Which basically means that he can contribute $34,750 to his retirement plan. And it could be pre-tax or Roth.
Yes, depending on how much income he has that year.
Exactly. So, and he can also create a profit sharing plan. By creating a profit sharing plan, he can also create a profit sharing plan that favors the highly compensated and that favors the older, that favors the business owner.
And something we're going to get into is, but he has no profit right now.
Well, actually, that's a separate issue, but he could do a profit sharing. That's a separate issue.
Yes.
But be that as it may.
Part of the point.
So let's establish a retirement plan. All right. So now we're done. That kind of crosses the bridge with the business planning and the retirement planning. Now we can put the rest of the retirement planning. So now let's talk about the business. So ever since 2018, when President Trump initiated the new tax laws.
Yes, the Tax Cut and Job Act.
Right. TCJA. They have what's called qualified business income deduction. The qualified business income deduction provides for a 20% tax deduction of whatever your profits are. And the profits are zero. And for those of you who don't need a calculator or do need a calculator, 20% of zero is
Zero.
and therefore his tax deduction is zero.
I'm good at this.
That's right. You got a calculator.
Yeah,
under the desk.
hidden under.
So we're like, John, let's talk to your accountant about this, because the rule is that if you reduce your salary, and let's just say hypothetically, he reduces his salary from 200,000 to 120. Okay. What that means is that he has $80,000 that is not being paid to Medicare, Social Security, and local tax.
Yep.
And that same 80,000 now becomes profit. He gets a 20% tax deduction on 80 grand.
Yeah.
So not only is he saving taxes on it, he's getting a deduction on it on top of it. He says, that's a pretty good idea. I said, but because of the fact that he is exactly 50-50 with his partner,
Yes.
I said, you need to do this with your partner as well.
Yep.
So he's like, all right, we talked to the accountant. The accountant's like, I agree.
Yeah. And it's, look, no one's getting any less money. You know, your $200,000 salary, now you're getting 120, you're increasing your profit, you're paying less tax on it. It's a win-win-win.
It's actually a win. You make more.
Yeah.
Okay. Win-win-win.
The only one who loses is three people we don't like. Mr. I, Mr. R, Mr. S.
Exactly. Okay. So we developed this idea. And then because of the fact that we spoke to the accountant in August, we said, hey, they're paying themselves $200,000. We're 2/3 of the way through the year. They've already paid themselves 120 to 130.
Yep.
What do you think? And the accountant said, absolutely. And here's what we'll do. We'll pay them zero for the rest of the year.
Yeah.
Because they've already got 120 into the system. Now, the kind of rule is they say, well, gee, forget the fact that he's owning and managing the business. The reality of it is that what does he actually do? And they say, as long as you're paying yourself W-2 income, a comparable salary to what somebody else on the street who does what you do,
Yep.
It's legit.
Yeah, make sure you talk, if you're going to do any salary adjustments, try and clear it through with a tax advisor or a CPA or something, because you can't pay yourself below what is referred to as a meaningful wage. You can't just pay yourself $0 so you can skirt taxes. The IRS will not allow that.
That's correct. And then you're subjecting yourself to an audit and tax evasion. And boy, that's just a slippery slope
No,
right. Exactly.
Yeah.
So we presented that. That was great. The accountant agreed, and the accountant said, all right, here's what we're going to do. We're going to shut it down because, wait a minute. He says, I'm concerned about my partner getting paid. He says, no big deal, because the rest of the year, instead of you paying the $80,000 in the form of salary, we're just going to pay the $80,000 in the form of
profit.
Draw.
Owner's draw, yes.
Owner's
absolutely.
draw. Which at the end of the day, instead of getting a W-2 that said you made $200,000 for round numbers, they're going to get a W-2 that said made $120, exposed to a whole list of taxes. Then $80,000 they're going to get in the form of a K-1, which is profit anyway, which is income.
Yeah.
At which the 80 then gets the 20% tax deduction and was not subject to all of those other taxes.
Yep.
We figure that's going to save both him and his partner somewhere between $20,000 and $25,000.
Yep.
A year in taxes.
Yes. If you'd like to talk about the business succession planning.
Yes, let's talk about that.
It also opens the door to something similar to what we're doing in our office here. I'll let you take this away.
All right. So because his partner's looking at leaving in about a year or so.
Yeah. Shares valued at roughly $250,000.
And so what we decided is that his payout, instead of buying out, basically there was never an agreement that he would buy out his shares. He basically just gave him the shares however many years ago, but told him, look, I'll pay $100,000. I said, look, here's what you want to do is you want to restructure your agreement, whatever the case may be. But instead of just letting him go, what you should do is actually buy out his shares. Now, then you buy out the shares. Okay. And not only that, but what happens is that the co-owner, instead of receiving $250,000 in ordinary income or W-2 income
Yep.
it's a capital gain.
Which is taxed always more favorably. And we had to do a lot of research for me to say always.
Not always.
Not always.
0 and 0.
Always, never worse.
Never worse.
There's
never worse. So, what we developed is a strategy that he didn't have in place, which is fine.
Yep.
Okay. But, this is the value of ideas.
Yep.
And the beauty of it is that when we had these discussions with the accountant, and I've had this happen many a times before, I actually saved a client $450,000. By the way, he likes me. What I did is I brought an accountant in and I said, hey, here's our idea. And he says, Mike, that's a great idea, because my idea was going to save him $250,000. He said, but I could do this backwards 3 years and saved him $450,000. So I didn't really save all $450,000.
Yeah.
But, fact of the matter is, two heads are better than one. So we were able to present some of the ideas to the CPA, and the CPA took our ideas and said, let's go further with this.
Yep.
Okay. And so that was a beautiful meeting. Love having meetings like that.
Yep.
I love having when a CPA is open to ideas,
Engaging, planning,
and working together.
Yes.
Okay. Because unfortunately, I've had, and this is not picking on the CPA thing, we've had a CPA meeting recently where the CPA had to make sure that they notified everybody that they are the smartest person in the room.
Yep. I'm sure there are other advisors that can
probably
say the same thing about you.
I know. And that's, unfortunate. So we're going to pick up on the tax planning in just a few minutes after we take a short break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're going to pick up where we left off. There's one other comment that we wanted to talk about with the business succession plan.
Yep.
Is what we were going to do is take the shares that are in the buyout and pass them on to the son.
The entire plan was for John to take over the ownership himself, right? Well, eventually you're going to pass it along to your son so we can... And that has its own complex of issues, but why not just get the son involved now? He's already in the business.
So what we're going to do is a similar kind of thing that we're doing here, okay? Is what we're going to do is, the son doesn't have $250,000 to buy out half of the business. So what we're going to do is give him a loan for $250,000.
Yep.
And what happens now is we turn around, and now that the business has all this profit,
Which didn't have before, yep.
what happens now is that we give the son a loan of $250,000. If that half of the business is generate a profit, we now take those profits to use to pay off the loan. And next thing you know, in 2 or 3 years, the son owns half the business.
Yep.
Okay.
And he has a cost basis equal to what he paid.
That's correct. And so,
as opposed to it being gifted to him or anything, he has no cost base. If it ever gets sold later, it comes with its own taxes. Yep.
It's a beautiful thing.
Yes.
It works out perfectly. And eventually, when John wants to get out of the business, he can do the same thing with his shares. Slowly pass his shares on down to his son by selling the business, to him, and then subsequently using the cash flow of the business to pay the loan, and effectively cost nothing to the son.
And we'll do the evaluation of whether or not he does sell it to him or lets him inherit it, receive the step up in basis. But that ties back into an earlier note on the value of their estate and whether or not they're exceeding the federal exemption limit.
Right.
Yep.
So
we got that one down pretty good.
Federal exemption limit now leads us to the 1,200-pound gorilla in the room. Okay, that gorilla's grown.
Yep.
So, we see that their estate is about $25 million today. And I'm not telling you that I have all of the answers, simply because of the fact that a lot of times, like the property and casualty, like the taxes.
Yep.
Okay. We're knowledgeable enough to know when there's an issue, but we're also humble enough to know when it's over our head.
We're not the experts of everything. No one is.
Correct.
Right.
So what we're looking at doing is bringing in a state attorney, because his estate's $25 million. He's like, oh, well, no big deal. You got an estate exemption of $15 million for him, $15 million for Mary. That's $30 million. They're under. Oh, no big deal.
Yeah, they totally increase that a lot with inflation.
Right. Okay. Two big problems is the value of their estate is growing much faster than the estate exemption is growing.
Yeah.
They're going to catch the estate exemption limit in less than 10 years for sure.
Yeah.
Now, that's if the estate exemption limit remains the same.
Yes.
I will have you know that there are a few topics that are on the chopping block every time they have tax law changes.
Yep, within Congress.
And one of them, and the first and foremost and front in line, is the estate tax exemption.
Yeah, because what it used to be before, 500,000?
No, 675.
675.
675, and then when Bush came in 2000, they increased it to $1 million, slowly increased it from $1 million to $5 million.
Yep.
And then 5, and it's worked its way to 15, which is amazing.
Yeah.
They look at that. I don't necessarily believe in estate tax simply because of the fact that you're going to be double taxed effectively on assets.
Yep.
But much like many other IRS rules, they forgot to consult with me.
One day they'll learn.
Right, exactly. One day they'll ask me what I think they should do. But
Every the day. Pigs everywhere.
Exactly. So what we're dealing with is, in theory, they could gift $15 million each.
Sure.
And walk away.
Yep.
All right. Well, you gift, and next thing you know, it's no longer your asset.
Yes.
Okay. You could gift it in the form of a grantor trust, but the problem, and have it maintain the step up in basis.
You lose.
But you lose
ownership.
Well, you also lose control of the growth.
Yes.
Because then the value of it remains in the estate. There's so many moving parts. So because the bulk of their estate is illiquid assets, and illiquid being
rental properties,
right,
business,
right,
yep.
Okay. The business isn't even that big of it. It's the rental properties,
of course.
Okay, because you're going to be force selling rental properties or just properties. And in a fire sale, that's not what you want to do. Actually, I don't know if you know this story, estate planning class.
I think I'm never going to go.
The Miami Dolphins.
Yes.
Okay. Joe Robbie Stadium. Joe Robbie owned the Miami Dolphins. Joe Robbie died without an estate plan, worth over $300 million, which is probably chump change compared to where it is today. Basically, it's not as if you could put the Dolphins and the Joe Robbie Stadium on eBay.
Can't buy that on Amazon.
Or on Amazon or whatever. Yeah, it's like you don't have a lot of buyers there.
Yeah.
They took a major haircut on the value of the Dolphins. I think it was Wayne Huizenga bought it, possibly.
Not too sure.
But anyway, whoever bought it, I think it was, ended up, he had no estate plan. You got to sell it within 9 months.
Wait, they didn't have $120 million liquid to pay that estate tax?
Don't you?
Not yet.
All right, not yet. So anyway, the long and short of it is that he needs to do estate planning. And I think, not knowing, it's very easy to not know. And then all of a sudden you know, and you're like, oh my goodness.
Well, you just don't want the IRS to become one of your primary beneficiaries. We see that all the time, and that is a real way of allowing that to happen by not doing proper planning there. And again, you're talking about the fire sale. We're talking about $20 million of rental properties. That's not built in a day. There's clearly a significant interest in this by both John and his son. You'd hate to, I'm sure John would have an issue if all of a sudden they didn't do proper planning and he had to his son had to sell properties that he worked hard to attain to pass on to him for taxes.
Yeah, that's ridiculous. So, and to Kyle's point, I'm not sure if that was in the first episode. I think it was. You were referencing insurance planning.
Yeah.
We don't really, he doesn't need life insurance.
No.
However, life insurance can be a tool of estate planning. Meaning, for example, if someone's estate limit is 30 million and their estate is worth 40 million, they have 10 million subject to estate tax, which is 40% of that is $4 million.
Yeah.
Okay. And the risk you always run is that what if they drop the estate tax exemption from 15 back down to 5, which, by the way, was in discussion.
Table, yeah.
Oh, it was on the table to bring it back to 5.
Absolutely.
Ramped up with inflation would have been 7. That means the estate tax limit for them would have been 14 and they're at 25.
Yep. It already would have been, to your point, just over $4 million in estate taxes.
Without growth.
Yeah. Now, for them, they do have the non-qualified account. They have retirement accounts, so you don't have to get rid of the illiquid assets in some sort of fire sale, but not everyone does. And that's where the insurance really takes more part. Like the Dolphins example, not everyone has $120 million liquid. That's where an insurance would have come in valuable.
And by the way, to your point, the problem with the IRAs is, and this is, you really want to get down to it, the IRAs are effectively taxed at almost 80%. Why? You're going to get whacked with 40% on Fed.
Yep.
You're going to get whacked 4.5% in Pennsylvania.
Yep.
And then, oh, by the way, you have to take out $1 million in IRA money all at once.
Tax rate.
Now you're talking about 37%.
Yeah.
So you're talking about 37 plus 3 plus 40. You're talking about those IRAs are going to get taxed at 80%. I'm guessing that when they were contributing to their retirement plan in their 401ks, they weren't thinking that it could be taxed at 80% coming back out.
You don't think they were getting an 80% tax deduction at the time?
Exactly. So, there's that. There's discussion. They have really nifty techniques called family limited partnerships.
Yeah.
Okay. And a lot of really complex things that they can do, but those are going above our head. And certainly above the scope of this.
Yes. And pulling it back, because we are running low on time, but pulling it back to what you just mentioned, they have a lot of these pre-tax assets. One of the things we were mentioning is the idea of Roth conversions.
Oh, we didn't talk about that. That's right.
All right. So Roth IRA conversions, he was paying himself $200,000. Let's say that Mary's making $150,000. We're always trying to limit ourselves to what will you pay in retirement? What will you pay today? What will your children pay upon inheritance? And we're talking 80%. We are very comfortable with the idea of converting up to the top of something like the 24% tax.
That is correct.
To the tune of 50. We can convert more to Roth with two things. One, reducing your salary. Shifts it to K1 is not the biggest impact, but the municipal bonds. We tied that in from the first episode. We went from taxable bonds earning 4% to municipal bonds, which are tax-free at the federal level, earning 3%. Net, a wash. So why do it? That's exactly why. Now you have less federal taxable income that you can do more Roth conversions, meaning that your children or you, when you're taking required minimum distributions, will pay less tax today than you otherwise would in the future.
So in their particular instance, we were looking at their 24 tax return, and they did a $50,000 Roth conversion last year, which is great. They left money on the table. They could have done over 100.
Yes.
And so that's one of the reasons why, and by the way, they didn't have that interest problem last year.
No.
At 0.02%. At 0.02%, they didn't have that big interest problem. So what we do is by doing that gives us the ability to convert more. Okay. And so that's why we chose going with the short-term munis as opposed to money market. So looks as though we'll be able to do about $100,000 a year in Roth conversions. In short, what we're trying to do is run ourselves to the top of the 24% tax bracket and not contribute to the pre-tax, because what we're trying to do is trying to get it out.
Yep.
Okay. Because one of these days, all of these rental properties are going to start producing massive amounts of income, because the only thing that's keeping him from having huge amounts of income is that he has all these properties on depreciation schedules.
Yes.
And once that depreciation runs out, which is 27 and a half years, all of a sudden,
pure income.
And then they're going to be through the astronomical roof as far as income goes. So now you see when you walk into something that you open a lot of cans of worms, and it's important to understand all the different pieces parts.
Yep.
So I think that pretty much wraps it up. Is there anything else that you think you wanted to add?
Covered that pretty well.
Good. Well, for the first time ever, I'm going to actually do a little bit of a plug at the end. I've never done this before.
I'm curious.
Yeah, well, so if you have any questions or you wish to have a consultation yourself, you are more than welcome to give us a call, and our phone number is 610-422-3773. Please check out our website, which is www.maaplanning.com. That stands for Menninger and Associates, maaplanning.com. On there, you'll see our weekly market recap that we write every week. What happened the prior week. It's a market commentary, 3 paragraphs. You'll see all of the videos that we have. We have them on YouTube. We have all of the podcasts on the various different sites. I think it's iTunes and Spotify, and I don't even know what Chris does.
The tricks of the trade articles. We put a lot of educational material out there on certain topics.
Right.
Yep.
Exactly. So, please feel free to reach out. We're happy to assist. We love this stuff if you haven't figured it out. In fact, sometimes, believe it or not, the more complex, the more fun it is.
Yes. More to do.
Yep. So anyway, thank you very much for joining us. We hope you have an absolutely wonderful day. Certainly hope that you learned something and enjoyed it while you're at it. So thank you. Have a great, great day. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there is an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.